About 4 years ago, I had my best investment ever, GameStop, making over 3000%. But after that, my performance in the market has not been so great. It was terrible actually. I underperformed compared to the S&P 500. If you look at my returns after the huge increase 150% in 1 month in January 2021, following that, my portfolio gained maybe 10%, reaching a peak in May of 2021. And then what happened was a decline. Until now, I have reached this peak again. I think it is important to discuss what happened in these 3-4 years, why my performance was so bad, why did I learn? Because there is a good reason why I believe I was able to get back to where I started. And I hope if I continue investing like this, I'm going to keep beating the market over the long term. The main issue I had after the GameStop gains was having too much cash in my portfolio. At some point, GameStop was over 50% of my portfolio when I started taking profits. We all heard about the GameStop short squeeze. I invested in the company in September 2019 the first time. So yes, I knew about the short squeeze and everything. I did not hear about it from Reddit. I did my own research. But what I want to point out is that when that short squeeze actually happened, and now you were investing, maybe my portfolio was around $15,000. Now my portfolio is much bigger than that. And most of it is cash. I took profit on GameStop. I'm not among these apes who still believe that GameStop short squeeze did not happen yet. It already happened. It's done. It's finished. If you made money, congratulations. You did not make money, you will find other investments later. That's what I thought. Yes, I should be looking for other investments, but I knew that this was the investment of a lifetime. You're not going to get another GameStop again. So what do I do with all the cash? Having too much cash is a problem. I started investing in other such companies. What do I mean by such companies? Companies that are cigar butt stocks. Deep value investing. Companies that are so cheap today for maybe bad management or something like that, but they have a good balance sheet. And maybe they can overcome that eventually by the management buying back shares like GameStop did. One such company was UNFI, another one was Trillion. These were terrible investments. And that's why my portfolio dropped by 30% from that peak. And if you have a drop of 30%, you need at least 43% to recover from that drop. And I did recover. Yes, I did have a few good deep value investments, Geo Group, Genworth Financial, but most of them did not work if you're going to look at the overall performance. And I believe that it's because these companies, they were very asset heavy. In order for you to make money in these companies, you had to make big investments, and the companies were using those investments, whether by issuing debt or maybe even issuing equity, in order for them to keep growing. And you don't want that. GameStop in many ways was an asset-heavy company. I won't call it capital-intensive, but it was asset-heavy. They had all this real estate. They could sell the real estate, which they were doing, but still it is asset-heavy. They need capital invested into the business for them to grow. They were not really trying to grow, but just to maintain the operations, they needed a lot of capital. When you have a store, there's a lot of degradation happening, a lot of depreciation, and you need to invest in that to maintain the same level. This is maintenance, capital expenditures. GameStop had that. What made GameStop different from other deep value opportunities was that there were so many catalysts on it. That's why it was an investment of a lifetime. But those other companies, UNFI, Trillion, they did not have this catalyst. UNFI had very low margins. And if you have a low margin company, if there is something bad happening in the economy, you are going to lose money. I don't invest in low margin companies anymore. It's a good lesson I learned. Trillion, very bad management. I don't invest in companies with very bad management. I can tolerate maybe average or even a little lower average management if the company is really good, really cheap, but bad management, no. Even if we look at Genworth Financial, Geo Group, these are asset-heavy companies. But now I have been transitioning this year into asset-light companies. Companies that do not require much capital for them to grow or just to sustain the business. The best example I can give you is Booking Holdings. You look at the equity of Booking Holdings, it is negative. That is, the book value is negative. They have more liabilities than assets, but they have been able to leverage one of those liabilities, I have talked about this in a video, to make money. On the balance sheet, it is a liability, but they leverage it to make money. This is the most important lesson I learned recently as an investor. I will say from all the mistakes I made in the past 3 years, this is what I learned. Deep value investing can work, but it is very unlikely you'll find a good company. You probably won't find one as good as GameStop, but even if you find a good one, it is very unlikely for you to find all the stars aligning in order for you to make the investment. It's better for you to focus on great companies that can return you money, because this is what investing is about. Let's say there is a box here. You're putting money into that box. You want the box to give you more money in the future. But what's happening inside the box is important. If the box has a lot of moving parts, these are going to be broken up, degraded over time, will need to be replaced. But now if the box is light, it's still giving you money, but there's no maintenance needed in the box itself. It's asset light. We have heard about it, assets are important, liabilities are bad. It's not true. It's not 100% true. If you own liabilities, of course, it's bad. But if the liabilities are giving you money, over the long term, what you want is cash flow. If the liabilities are creating money for you or creating cash flow for you, you should own liabilities. You need to have liabilities. This is what Booking Holdings is doing. This is what many people do in real estate. Even though real estate technically is quite capital intensive, because you have this big house that doesn't move at all. But a business, it can be capital light. You can lease your buildings, make money from the business. A business like Booking Holdings doesn't require much capital to operate. Meta is another one. And I invested in Meta in 2022. The mistake I made, and this is the second lesson I learned, was I did not go too big on Meta. If you find a company, great company, you should go big on it. If you think really it is undervalued, everything is working out well with the company, the market is overreacting over something, go big. I went big with GameStop. I made money. I went big on GameStop. But with Meta, I don't know why I was a little reluctant to go big on Meta. Maybe I was hearing all these people saying we have an index fund that bubble, don't invest in big companies, look for smaller ones. I think that was what influenced me. I'm not sure what it's 2 years ago. I already forgot. But now I know I should have invested more in Meta. And today, my top positions, I think I have over 40% of my portfolio in just 3 companies. And probably it's going to get more concentrated. Of course, you always need to consider the price. It's not because a company is great that you need to buy it at any price. I talked a lot about Booking Holdings today, but it's not that cheap anymore according to me. I would recommend you watch this video next. It's a fantastic company. Have a nice day and goodbye.